we are yet to see the large part of transmission of those high interest rates that have come through in this cycle to the real economy. So this is really just the tip of the iceberg that we have at the moment. I mean, so far, why the recession has been pushed out is because of the excess savings that the US consumer has.
Welcome to The Curious Investor, Saxo's video series on topics that drive the investment markets. I'm Hou Tian. It is 2023 November. Together with me in the Singapore office is Charu Chanana, Saxo's market strategist. Today, we'll be discussing about the outlook for global central banks. Charu, good to have you here today.
Thank you, Hou Tian. Good to be back on this show. I think we've had a gap of a few weeks, but it's glad we're doing this again before the end of the year, and such a pertinent topic as well. You know, everyone's living in this hope that the Fed will now cut rates, but we are going to get a soft landing, and then the over-allocation that most of the investors have had to US for such a long time will continue to work. So I think it's really a good topic. We discuss about whether we really get that soft landing or a recession or not. We talk about the global central banks, as you say, and see what that means to our investments as well.
So let's address the elephant in the room. Are we looking at a soft landing or a potential recession? Because if we look at the recent data that's been published, we see that unemployment data has been slightly weaker than expected, but at the same time, retail sales have softened, but not as much as the expectations. What do you see from here?
I mean, that's really, I think, the big question, right, to answer. So many investment banks have been calling for a recession, I think, since late last year, early this year, all through this year, but recession continues to be delayed. We still think that a recession is more likely than not. I mean, in fact, if you look at the consumer side of things in the US, we've talked about this before. Pandemic era savings are starting to run out, and we are yet to see the large part of transmission of those high interest rates that have come through in this cycle to the real economy. So this is really just the tip of the iceberg that we have at the moment. I mean, so far, why the recession has been pushed out is because of the excess savings that the US consumer has had. But now, I think if you look across the income distribution in the US, more than 80% of the income distribution, they have used up their excess savings. So that's a warning sign for us. And, recession kind of never comes in the same patterns. I mean, all the leading indicators that we have for the US economy, for the global economy, they've been devised based on those past recession models. But it's not necessary that things are going to play out in that fashion again. So, those leading indicators may not be doing a good job of predicting a recession, I would say. And of course, there's, obviously large variable lags that we have seen in the cycle. Potentially is because of all the supply chain shifts, potentially because of pandemic era fiscal stimulus measures that were, announced just ahead of this tightening cycle as well. So, of course, the economy is not in the same place as it was in the past tightening cycle. So the reaction function is also likely to be pretty different. So I think going into 2024, I would be really cautious of where global economic growth can go.
Right. So I see that the markets hasn't been really pricing in a rate cut, at least until the middle of 2024.
Yeah.
So the thing is, I guess we need to change, our focus, or I rather say, what we're looking at, because it seems like we're not looking at any more rate hikes. Rate hikes are probably past that at the moment.
Yeah.
So I guess the next thing that we are looking towards to are, when the rate cut will be coming in, and how much anyone's cutting, who's cutting first, right?
Yeah.
So what's your take on that?
So yeah, I mean, of course, I think again that's an excellent question. And a lot of people want to kind of start looking at who cuts first, who is more aggressive, when does the first rate cut come? These are really some of the things that are top of mind for most of the market participants. And if you look at, past cycles, actually Fed has been leading in most of those cases. But now coming to the cycle again, which, as I just said, has been very different from the past cycles, can we still expect the Fed to be the first to cut rates? I mean, even if the US economic data is starting to weaken, as we said, likely to weaken even further in 2024, I I think we pretty much understand the fact that economic data for Eurozone, for the UK economy, looks even worse than what it looks for the US. So that US exceptionalism story can still run a little bit further, despite the fact that we still obviously believe that the Fed rate hike cycle has ended. So, of course, a lot of moving parts. I mean, I would think that the ECB and the Bank of England will really have to keep pace with the Fed, if not, maybe even move ahead of the Fed in terms of that cutting of the rates. And in terms of the overall timing as to when it starts, like you said, Fed is priced to start cutting rates from May. I think ECB and Bank of England to follow from the second half of the year. That's what the market is pricing in for now. But I mean, because we are concerned about economic growth from here, credit growth from here, we do think that the markets at some point will have to bring forward those rate cut expectations. Maybe as early as Q1, at the end of Q1, we are likely to see those rate cuts starting to come in as well. Because I think one very important point to consider here is that if these rate cuts do not start as early as we're saying they will, something might break. And we are getting into an election year. 2024 is an election year in the US. Potentially, the Fed would not want to see something breaking at this stage. So I think that's what our expectation is. But some of the other central banks, potentially the Reserve Bank of Australia, could wait a little bit longer. We're still getting some hawkish vibes from the Reserve Bank of Australia. Inflation and jobs numbers are still a little bit above their expectations. So there are chances that they may not hike anymore in this cycle, but the rate cuts are likely to begin only after the Fed has started. But some of the emerging market central banks have actually already started their rate cut cycles. I do see that the scope for rate cuts in emerging Asia this time could be a little bit more limited because their tightening measures have been a little bit smaller than what we've seen in the previous cycle. So they have limited room to cut rates, so they're going to be cautious. But they could still, again, move ahead or in step with the Fed to cut rates. But Latin American emerging markets, I think they already have started. Even some countries in emerging Europe have already started their easing cycles, and they're potentially going to continue to do that as we get more clear signals on the Fed pause.
It sounds like there could be a couple of complications or implications from what you're saying. So if I'm an investor in the markets right now, what are some of the, I would say, the key metrics or key data that I should be looking at? Since there seems to be many moving parts in this at the moment.
Yeah, but I mean, actually, if you look at data very closely, things can be a lot more confusing as well. These days, what we've been observing really is that any data point will have an impact, either a knee-jerk or at most for 24 hours, and then focus really shifts very quickly to the next data point. So I think it's really hard to kind of make sense of where things are going if you are being extremely granular. It's such a noisy world, and to be able to make sense of things, like it's just the way like it is with social media. Things are moving so fast. So it remains really hard to draw implications. So I think you really need a bigger picture as to where things are going and kind of have your portfolio in line with what you think could happen in 2024. I think for me, the biggest investment implication of everything that we discussed just now, the rate cut cycles are likely to begin. The Fed, ECB, and the Bank of England likely to be some of the first movers. I think a very clear implication really is to obviously put some money in bonds, which have been giving us really good yields at this point. A lot of people have asked us about whether we should still keep, cash because, of course, of recession concerns and, because things could get really bad and then markets could get really hit, where I think I would really highlight 2 points why bonds make a lot more sense than cash at this point. Because one, So if you're putting your money in a deposit account and you're happy with the fact that you're getting 5% today, you're still not locking in that yield. And when interest rates start to go lower, when the rate cut cycles begin, then in fact, even before that, then the deposit rates will start to fall. But on the contrary, if you put that money in a bond, you actually lock in that 5% yield. And the second reason itself is, yes, a recession, which if it was to happen for bonds, that would mean that you also get capital gains. But of course, and because also I think I would still be a little bit concerned about inflation. Of course, inflation is going to come down as consumer slows, as economic growth slows. But there are a lot of reasons to still worry about inflation sticking higher. And if that is the case, then of course your cash, the value will be eroded by high inflation. And especially if deposit rates kind of go lower after the rate cut cycles begin. So I think just steering into some high quality bonds would potentially be one of the first things that I would do with my portfolio at this point.
Right. So Charu, I do hear you that it's a great time to lock in some of these yields that we see in the bond market. But what if I am a equity investor? As we probably know, equities are a good way to combat inflation in the long run.
Yeah.
So, what if let's say I want to get into the equities market? What do you think I should get into? Should I be in tech? Growth sectors? What's the take?
So, I mean, absolutely, a lot of our clients as well kind of want to kind of answer that question. But for now, I would still kind of, emphasize that, given where growth is headed, we probably have a catch down there to kind of play out. And that still means that I think staying defensive would probably be the best strategy at this point. And again, given how equity markets have fared this year, been driven by the Magnificent Seven, cyclicals are likely to get hit, of course, as the economic cycle turns. So I think I would be really cautious of those two particular areas. I think being defensive, talking about sectors like staples, talking about pharma, talking about utilities, these are things that continue to do well despite a recession. And I think what I would really say is that having a well-diversified portfolio. So we have, I think, a lot of good opportunities right now in emerging markets, in potentially also in Japan, where corporate governance has really played a part, and just the whole comeback of inflation has been driving the Japanese equity market to new highs, even this week itself. So I think there are some very interesting opportunities if you look from a very geographic standpoint of diversification as well. But going into 2024, you're right. I think a lot of these questions will continue to come our way, especially when the Fed starts to signal that they have ended their rate hike cycles. So far, they are going to continue to try to say that they might hike again. I know the market's not buying it, but once they obviously kind of declare an end to their rate hike cycles, that will be really the time to kind of add on more risk, add on more duration to your portfolios, which would potentially include tech as well. But again, I would highlight with tech, I think it's a time to be extremely cautious because of the valuations that it has got to this year after the run that we've seen, specifically in those the top 7 stocks.
So it sounds like we should always remain invested in the markets. So whether you are a single asset trader or multi-asset investor, Saxo is a great platform to be on, as you can access multiple asset classes. So thank you so much for watching. Do remember to like and subscribe to our videos.